We got Business Builder Bees in the building with us today, and he's about to drop some exclusive gems. So y'all make sure y'all grab a pen, grab a paper, because he's going to be dropping some game-changing information. Welcome to the channel, Bees.
Thank you, my brother. Appreciate it. Business Builder Bees. Yeah,
absolutely.
Here, man.
One of the questions, so we talk a lot about credit on this channel. I tell people, show people how to go about getting credit. But one of the things that a lot of people ask me is, hey, Credit Plug, after you get all this credit, like, what do you do with it? How do you actually make money from it? How do you deploy it? I know how to get the credit. I know what data points are needed to go to the banks and the lenders to get financing. But then it's after you get the financing, what do you do with it to deploy it, to bring it back safely, to make more money from it? How do you actually leverage credit or leverage your money to make more money? That's exactly why we got you on the channel. We hear a lot about different business models, whether that's Airbnb, Turo, Amazon FBA, but you have somewhat of a different approach. And I know a couple months ago, you reached out to me after the interview we did with CEO of One United, where they were talking about the huge opportunity that's currently underway right now when it comes to purchasing existing businesses, right? And so I wanted to talk about that. So can you explain what that opportunity is right now, and why is it so important right now for those of us who are looking to get into business to maybe seek out some existing businesses rather than just trying to start their business from scratch or try to reinvent the wheel?
Yeah. So first of all, what you're doing, feeding the community with information on credit, is phenomenal. It's the lifeblood of creating wealth, because that's the foundation. Honestly, didn't know about credit growing up. In Jamaican, Caribbean background, growing up in Jamaica, I was taught things like credit's bad, debt is bad. That's not true. There's good debt and bad debt. You got to know how to utilize it and use credit, OPM, other people's money, to grow. So there's three major ways of creating big time wealth. I'm not talking about just a little riches and you're doing some Turo and you made $1 million and that's it. I'm talking about creating true wealth, right? Now, the first is real estate. People amass a huge portfolio of real estate, and those tend to be the rulers of the world, right? The second is the financial markets. That's going to be your stock, your Forex, now also your crypto. And then the third is owning a business. Whether you buy it or build it, I promote that you should buy a business. Or to be honest, the true word is acquire a business. Depending on how you do it, you don't have to come out of your pocket in order to do it. And that's the key part that people are like, what are you talking about? When you start a business, more than 80% of businesses are gone after 5 years. Shut down, didn't work, failed, and it's done. On top of that, less than 5% of businesses make it to 7 figures. So why not acquire a business that's already older than 5 years, already made it to 7 figures, right? Now you got not only the head start that you deserve, but you also got the recipe, right? Because one of the things that I hear people say when they hear about this, they're like, well, first of all, I never ran a business before, so maybe it's better I start my own business instead of taking on another business and I could fail at it. Oh, because you won't fail if you start the business yourself? Like, that's not true. We have to break that mindset of, no, the only way that I could be successful is by building from scratch. Acquire it, then continue to build it if you want. But at least you got the head start, right? Now, of course, most people are going to say, yeah, Bees, you got money. Plug got money. Y'all could go buy a business. I can't do it. And that's why you had the lady that was on here before.
One United Bank.
One United Bank. And she's telling you the traditional way of acquiring a business, but we just don't think about it. If you can go buy a house, if you can buy real estate, you can buy a business, right? So how you buy real estate, especially if you're getting an investment property, you get a loan, you put some money down, and that's going to depend on the actual deal, how much you got to put down, and depend on your experience on how much you got to put down. And in the business acquisition world, you're going to use the SBA 7A loan. You find a business for sale, you can start with bizbuysell.com. Once you find a business, you go through the SBA 7A loan. They're going to vet the deal, helping you with due diligence. And then you got cash flow immediately. That's another question people ask. How soon after you acquire a business can you make money? The day you get it, it's already making money. It's a mindset shift for sure.
Absolutely. And I think too, when people were thinking about businesses, this is even something that I found myself in, where you're not necessarily thinking about more staple types of businesses, boring businesses. I know nowadays with social media, people are thinking of all of these popular business models, but believe it or not, a lot of traditional businesses dry cleaners, restaurant businesses, waste management, like a lot of these types of businesses that I forget the term you use, but recession profitable. So it's like businesses that people are going to need regardless of what the current macroeconomic conditions are. And sometimes those aren't really the areas that we might be looking at, because a lot of us may want to be looking at what's popular, what's trending. And oftentimes what you might find, especially with some of these template types of businesses, once everyone starts doing it, it becomes saturated with a lot of the marketing that's out here. And you could probably speak on experience as well. Sometimes it's not always beefed up to what it actually is, right? And so I think even exploring the alternative route in terms of buying existing businesses might be more valuable, right? Because you already have this proof of concept established from an existing business, right? They've already created a product or service. There's already an existing market. And most importantly, it's generating cash flow. When you're acquiring these businesses, you basically are able to, in the same way you explain, like buying a house that's already been built, buy a business that already exists. So to get back to my other question, right? I did touch on this in the other interview that I did, where right now you have a huge population, baby boomers, maybe our parents' age, who are maybe in their late 60s, 70s, 80s, who they've been running businesses for quite some time. And oftentimes there may not be that family member to pass it on to. Right now, I think the baby boomer generation is the biggest in history, reaching or nearing retirement age. And it's occurring right now. I'm not sure exactly what the numbers are. This presents an opportunity for a lot of us to get into some of these businesses, buy up some of these businesses, and continue to carry those on. Talk a little bit about that opportunity, where you see the purchasing of existing businesses going over the next couple of years. What are some of your plans in terms of taking advantage of that and increasing your assets under management?
Man, you're speaking my language. I love it. Let's go, right? So the first thing is that you hit the opportunity on the nose. I go to motivated sellers, just like in real estate. You prefer to go to motivated sellers, right? Now, there's multiple types of motivated sellers. Somebody's getting divorced and they were running a business. Now they're divorced. They got to get out the business. Or there's somebody's had a brick and mortar shop and they're moving out the country and they need to sell the business. I prefer the retirees.
Right.
Now, there's 50 million approximately baby boomers in this country, of which 12 million have businesses. All baby boomers are retiring this decade. And just like you said, some of them don't have a child to pass it on to. To be honest, the newer generations, many of them don't want it.
Don't want it.
You know what I'm saying?
They want to be YouTubers and TikTokers.
I mentioned a site called Biz Buy Sell, BizBuysell. Go check it out. It's an online broker site to find businesses for sale. That site, the largest online broker site for businesses for sale, put out a statistic last year that says something like 80% of the businesses that list on Biz Buy Sell don't get sold. That's not because they're bad businesses. It's because there's not enough people that know they could even buy a business. Most people think it's something above them and they can't do it. So it's just right for people like me and you who are like, yeah, hey, we gonna swoop in and take it all, right? Now, you mentioned something else. When we're looking at not just popular business models, but trendy business models, the Airbnb stuff, the renting your car out stuff, I look at them as not sustainable in their current form. Saturation is one reason why it could be unsustainable. So what we need to do is stop focusing on plays, especially our community. Our community is always talking about, hey, I got this play. You can find this play real quick. What that equates to is the dude on the corner street, like, hey, you want to buy this watch? So plays get played out. We need sustainable strategies that are not going anywhere. It's the foundation of creating wealth. I'm focusing on acquiring multiple businesses, and I'm not being the CEO of it. I don't want to work in it as a self-employed. I want to work above it as the investor. Now, when you start a business from scratch, you may be like, oh, I don't have enough revenue to hire anybody, much less a CEO. That's why we buy the business or acquire the business so that it already has cash flow, customers, employees. It already got the processes laid out so you know exactly what to do every day in order to get money made. If you do it the right way, if you acquire or do a stock purchase, it even got tax returns, business credit that you can acquire instead of having to build your own business credit. You can't beat this investment strategy because it's the one that lets you reduce your risk as much as possible. You get to see all the documentation up front before you make a decision to go forward. You see all their financials, 5, 10, 15, 20 years worth of profit and loss statement, tax returns. You see what they've been doing, right? I already mentioned there's the traditional way of acquiring a business, getting a loan like the SBA. Right? Now, I want all your viewers, I don't get no affiliate link, no nothing for this, but I promote this book nonstop. This book right here Why should white guys have all the fun? It's the story of Reginald Lewis. He's the first black billionaire in modern times in America. And most of us don't know his name. He did it by buying businesses, acquiring businesses, using a strategy called LBO, leveraged buyouts. Now, leveraged buyouts is what I do. If I speak to 20 different sellers, maybe I got 3 of them doing a full leveraged buyout, but maybe I got another 3 and I had to put 10% down or something. And then the rest of it, I just didn't go forward with. So you got to play the numbers too. It's not like everybody I speak to, I'm immediately getting a business, no money out of my pocket. You got to go through the actual routine. If I got to speak to 20 people and now I'm getting $1 million businesses that are going to be acquired by me, I'm perfectly fine with that. I don't think that's too much to ask to do.
Absolutely.
So overall, I think this is something our community especially needs to not be afraid of and not think, oh, I can't do it. And not think, oh, I'm already an entrepreneur and I already started building my business, so I'm not going to acquire it. I just need to focus on this. The way that you scale your existing business is by acquiring others and rolling it up into it. Instead of starting a whole new marketing department and I need to really improve my marketing, look, you can acquire a marketing company and roll it in, or keep it separate and just make it provide the service to this other company while also having other clients. So
Absolutely.
definitely the way to create.
So let's talk about this, right? You share with me, you come from a consulting management background. Same with we worked for one of the same Fortune 500 management consulting companies.
For DHS, Department of Homeland Security, through extension, that's when I was living in DMV area.
Their main office was out in Arlington, Virginia.
Reston.
Yeah, they got a couple. Huge company. Coming from that consulting background, and I know just from being in your program, you're big on process, right? Talk about how you use your management consulting, project management background, and then apply that to be able to, from the businesses that you've acquired, right? Because if you're looking to grow and scale, ideally, you can't be working in each and every one of your businesses, right? You got to be able to put processes in place, delegate. You actually have to be able to manage people, manage relationships. Talk about the importance of processes and management when it comes to acquiring businesses and scaling businesses. How do you utilize those skill sets to be able to grow and scale?
So the first benefit of my background in consulting is the mindset that it gave me. A lot of people, one of their objections when they hear everything I'm talking about, they're like, should I only acquire in an industry that I know? No, you don't have to. Why? Because I'm not working on the front line. As a consultant, I was already used to being sent into different industries to help them improve or remove waste in their processes and help them to scale and help mergers so that teams could be working together more efficiently. It didn't matter what industry I went in. I've taken that mindset in my acquisitions too, where I acquire across the board, all types of stuff. I selected my preferred 5 to 10 and I acquire across it because it doesn't matter what industry I get into. I'm going to put the right people in place to operate it so that I'm not having to work in it. Now, when it comes to the scaling aspect, whether you build a business or buy it first, you still want to grow it. Growing any business is going to always be process. You got to know what needs to be done in order to achieve a specific goal. You got to have metrics in the process, KPIs, key performance indicators. I took all of that from my experience in corporate America and said, any business that I'm building or acquiring, I need to do that first and foremost, understand the process. Then you want to put systems in place. Systems are going to help to automate the process. Systems are going to help to make things move quicker, reduce more waste, and increase your throughput so that you can have more profit coming in. And then you need to focus on people. That's critical. When I walk into a new acquisition, which I'm about to do next week, the first thing, everybody's, oh, damn, got a new owner. We about to get fired. Oh, no way. The reason I want this business is because of the work that y'all put in to get it this much revenue and this much profit. I'm keeping the people. I'm giving the people a career path. Okay, you're at this position, but we're going to do reviews so that you can continue to grow and earn more money. You got to take care of your people. But then you also want to know how do the people work together with each other. So all of those things, process, systems, and people is the absolute basics, the absolute foundation of scaling any company. I got that from corporate America. So if you're in your 9 to 5 and you want to become an entrepreneur, take things that you learn from your 9 to 5, right? You're like, oh, they always talking about SOPs, standard operating procedures. Maybe I need to make sure I put SOPs in my business too, so that everybody knows what needs to be done. And when I hire somebody new, they can be trained quickly. Take the concept, the things that you see happening in your 9 to 5, they're a big business and they do it for specific reasons. So you can do it too.
Absolutely. So let's go back to what you discussed earlier about one of the strategies you use to acquire businesses. Now, when I used to hear leverage buyout, I always thought it applied to, if you're on Wall Street and you're talking about major $100 billion corporations using these strategies. But even on a smaller scale, you're acquiring a business for a couple million or maybe a couple $100,000. Can you explain to our audience what exactly is a leverage buyout? Is this a strategy that someone could utilize even if they may not have that much capital?
Yes, 100%. So you don't need credit. You don't need money in order to acquire a business. If you have it, it's going to give you more options for sure, but you don't need it. And it's all about how you structure the deal. I already showed you this book, Why Should White Guys Have Fun? Because it changed my life, and seeing another Black man that did this and how he did it and became a billionaire, you get to learn the entire story. This is a must read for y'all. But then this book right here, Barbarians at the Gate, this is the story of the RJR Nabisco buyout, right? Nabisco's buyout in the 1980s. So this was the largest LBO in history at that time, until last year when Elon Musk did a partial LBO with Twitter. Most people don't realize that. They think he spent his own money. Nope. He put debt into Twitter in order for him to acquire it and do whatever he wants with it. Now, when it comes to an LBO, I'm going to break this down, so make sure that y'all have your pens out, you're taking notes, because I'm going to speak a little bit fast through it. You can make $1 million in 10 minutes. It's not like that. There are steps to this, but none of them are difficult. The most difficulty you have is if you're not a good speaker and you feel uncomfortable talking to people, you got to talk to the brokers and sellers. There's no way around that. You just got to practice and you'll be good to go. Now, here's an example. Let's say I have a company I want to acquire and it costs $1 million. Keep in mind, the steps I'm about to explain can be done with a company that's $1 million or a company that's $1 billion. So we always think, like you mentioned, that's just for the $1 billion ones. No, let me show you how you do it even with a $1 million company. The first thing I'm going to say to them is I want some seller financing. It's also called owner carry. This is something that existed for generations. Like I told you, this LBO in Nabisco was in the 1980s. So it's been going on even well before that. Seller financing is common when you're doing acquisitions. Seller financing means that the seller will allow you to pay a portion of the purchase price or the selling price over a long period of time, 5 years. It used to be 5 to 10 was common. I see a lot of retirees asking for 3 to 5 now because they're like, I don't know if I'm gonna still be here that long.
On that money.
So 3 to 5, cool. So 5 years. And what's the average amount that somebody would give? I often get no lower than 50%. I don't go for deals if they won't give me 50%. Do people tell me, hey, no, I'm not going to give you no seller financing? Sure. And what do I say? No problem. I see you in 6 months when you haven't sold your business yet. And then you're more of a motivated seller because there ain't enough people buying businesses. So seller financing, let's say I get 60% in this example. That means $600,000 is going to be paid to the seller over 5 years. So that's 60 monthly payments until it's paid off. But who, I'm asking you this plug since the audience can't answer, who is going to pay those monthly payments?
It's going to be the business that's acquired.
There we go. So right there, $1 million business, 600,000 of it not coming out of my pocket. The business that I'm going to acquire is going to pay it over time. And I already know the business has enough revenue and profit to pay it because I saw all the financials before when I was doing due diligence. Okay, you say, bees, that's still 400,000 left. Where are you going to get that from? That's going to come out your pocket? No, it's not. Because what we're doing is we're stacking the deal. We stacked it with the first thing, seller financing, took care of 60%. Let's say I do another concept called, since we on Plugs channel, we know that we could get no interest business credit card for 12 months. I could actually get longer. I know some that you could get for 20 months. I probably learned some of them from you on your channel, but let's say 12 months. Now, let's say I got just two $50,000 cards. That's easy to get in business credit, right? So two $50,000 limit business credit cards. And then I use a tactic called MS, manufactured spend, in order to liquidate the card. Now I'm going to take that money, that's $100,000, and I'm going to say, okay, here's another 100,000 out of the 400 to go to the seller. And then the business is going to pay back the credit card balance before the interest even kick in. So now that was free money for me to add towards this. Another concept I might use, because now we've covered 700,000 and we still got 300,000 left, is called DDP, deferred down payment. You got to justify why you're asking for DDP, but you could do it. DDP says, not as long as seller financing, but I'm going to pay you the remaining 300,000 over 30 days or 60 days or 90 days. All three are typically the most common. Sometimes I've seen it as much as 180 days, but it's 30 to 60 to 90. Okay, cool. Now you may say, yeah, but Bees, I still got to come up with that money in 60 days. Let's say I take over the business on day one, because with DDP, that means I get the business and I'm paying you later for that balance that's left. I take over the business on day one. Day two, I might go to a FinTech bank institution. I learned about that on Credit Plug's channel. Right? And the Credit Plug tells you all types of FinTechs that you could go to. With this FinTech institution, I'll ask for a revenue-based financing loan. Revenue-based financing loan is not based on your credit. It's not based on the business credit. It's only based on the revenue that has been in the business for the last however months, 3 months, 6 months, whatever. So they're going to look at the bank accounts. They're going to say, oh, I see you've been running $400,000 a month through this business, or $200,000 a month through this business. I'm not talking about profit, just money being
revenue.
The revenue. Okay, cool. We'll give you $200,000 and we'll take out 5, 10, 15, 20%. You choose the amount out of every transaction after that until it's paid off. Right? So again, we already know who's paying that off. That's not me. Again, it's not coming out of my pocket. It's coming from the business. So we got $600,000 from seller financing. We got $100,000 from the credit cards, the business cards. Then we just did another $200,000 that they were going to give, 7 plus 2. So now we had $900,000 covered, not coming out of my pocket. I got $1 million business that is grossing. It's valued at $1 million. It's probably grossing like 1.5 to 2 and profiting over 500,000 or so, somewhere between 3 to 500,000. So I've just bought cash flow. Now you may say, okay, Bees, what about that last 100,000? If you're still asking that, then you're not following along, because you see that there's multiple ways to stack the deal. In my community, the BDI, where I teach this, the Business Builders Institute, we have over a couple hundred options of what you could do to stack the deal. And depending on the situation you're in, you're going to choose from that list and say, hey, you know what? I could do an earnout. An earnout is where, let's say I did the earnout in this one. So 100,000 was left, 10% of the $1 million cost, right? Let's say I was looking at the numbers. And remember, you don't have to be a financial professional to be able to look at P&Ls and stuff. So you look at it first, bring in a third party to do the financial due diligence for you. Bring in the lawyers, they'll do the legal due diligence for you. So let's say I'm looking at the numbers, and my financial teams that I brought in, they were like, okay, so it doesn't look like a healthy business. However, we've seen a significant downturn and it's trending down for the last year and a half. That's a concern. Do I run away from the deal? No. It gives me more leverage. I'm going to say something like, because I see what you've been doing and that trending down, your valuation is supposed to be at 900,000 instead of 1 million. Now we'll do it for 10%. So in 12 months, if we meet these performance metrics, then you get that 10% also at that valuation of 1 million. If you don't meet those performance metrics, you're getting it at the true valuation of 900,000, because that's what you should be at.
Interesting.
A $1 million business. And I've only told you a couple of things to stack the deal with. We have a couple hundred that you could choose from.
Wow. That's interesting. So you basically use some of the information that's gleaned from the P&L or some of the other KPIs to negotiate the valuations. That's pretty interesting. One question that I know people might have in terms of stacking the deal, using the LBO, the business is taking on a lot of debt in order to be acquired. And so for the first couple of years of taking over that business, obviously a lot of the revenue is going to be eaten up from covering the debt service, seller financing, and some of the other methods you use to stack the deal. Is that typically the expectation when you're taking over some of these businesses, utilizing debt, that you may not see as much profit as you may have anticipated, 100% in cash? Is that something that you anticipated for the next 2 to 3 years? This business is going to be working back some of this debt, and then year 3, 4, 5, this is when we're going to be in the green, seeing profits. Is that the expectation when you're using some of these different strategies?
Yes and no. One of my last acquisitions, it was such a good deal, such amazing numbers, that I brought in investors to take over, to pay for 50% of it. So together, we only had to pay the other 50% seller financing. They came in because they bought in. So that's not debt that I got to incur in the business, because they got equity. That's their ROI for their debt or for the money they lent. The business is not in debt to them anymore. It's just that you're going to get equity and their percentage paid out. It's extremely important, especially in our community, to remember that 25% of a watermelon is better than 100% of a grape. So I have multiple businesses, multiple companies that I own, or that I own stake in, and is paying me passively, right? This one I own 20% in, this one I own 80% in, this one I own 50% and on, right? Because if we feel that I need all the equity, then you're probably gonna have to do all the work too. You don't have anybody that has that vested interest in the success of the business like you do. So nobody will live up to your standards, right? So stop focusing on one and considering it your baby. Nah, get a whole boatload of babies you can or something. I don't know.
Let's talk about that real quick, because I know a lot of times, even online, you hear a lot about LLCs, S Corps, C Corps. Can you talk a little bit about general partnerships, limited partnerships, and how you utilize some of those legal structures when it comes to coming together with multiple different investors, different partners on a deal? Maybe you don't own it 100%, but you might have 20%, 30%. How does limited partnerships work, or general partnerships?
Perfect. And after that, I want to go back to the last question too, because I want to elaborate more on one aspect of it too. Go back to that question about debt, how we're servicing the debt, because I have certain numbers that I only go for. Because if there's not enough profit in it, if the profit is going to be eaten up by all the debt, then I won't do that one. I'll explain those rule of thumbs as well. So just remind me about that. When you're going into the JVs, I've started and failed so many companies in my lifetime, right? And I would estimate 80% of the failures had to do with a partner. I realized that, hey, I ain't getting into no partnerships. I'm just going to handle it myself. I'm only going to pay people, hire people, instead of getting into a partnership. I still believe that to be true when you're starting a business. It's so dangerous when you're starting with a partner. So many things could go wrong. But when you're acquiring a business, I feel it's this a little bit better. You're going to have two things in general. You're going to have your GP, that's a general part. They tend to be majority owners, right? Majority shareholders, and you define what that majority shareholder level is. So anyone who owns 25% or more is considered a majority shareholder. You define that in your investor terms, your term sheet, your term and agreement. No business that I acquire is B's acquiring the business. It's always an entity. That entity is my SPV, my special purpose vehicle, whether it's a LLC, C Corp, LP, whatever it may be. And my special purpose vehicle is what I use to acquire a business. So I'm going to create a JV entity. I'm going to say, okay, we getting into this partnership with some people. We're going to acquire this business. Let's create a JV and talk about exactly how the JV is going to operate. Who are the majority shareholders? How long will the JV continue for? You always need to know the end goal, the end result. The current one that I'm doing, we said 5-year JV. You cannot sell your shares for 5 years. And here's the potential return you're going to get each year. And after 5 years, you could opt to either sell or opt in for another 5 years. You set up your JV entity, whatever it may be, LLC, C Corp, whatever. Then you're going to use that entity to take over the other entity. So you have two types of purchases, a stock purchase and an asset purchase. Most acquisitions are just an asset purchase. Okay, we got all your assets, your trademarks, your customer list, everything. And then we're going to put a DBA for your brand name, and we own your brand name, right? But when you do a stock purchase, you actually take over their SP, their entity. So now your entity, your JV entity, becomes the member of the entity that you took over, right? So like a member of their LLC. That's the main things that you want to do when it comes to getting into partnerships is you want to set up a SPV and you want to dictate the terms. You want to have, how are we going to do votes? Who has what voting rights? How often do we meet? How often are distributions paid out each year? All of that you want to define in two places. The initial term sheet that you send to an investor and say, hey, here's the overall acquisition and here's the general details of what the JV is going to look like. And then the next place is in the operating agreement. So now you got your investors on the term sheet, you created the JV entity, and I have to create an operating agreement that says every detail of how you're going to operate going forward. And you want to have attorneys involved in that to help you with it for sure.
Wow, no, that's really helpful information. Let's go back to the point you were making about how you look at some of the deals, okay, to determine, can this business acquisition actually handle the debt? What are some of the KPIs or metrics that you evaluate? Obviously, the revenue, expenses, things like that. How do you know that there's enough meat on the bones for the business to be able to absorb a lot of the debt incurred from being acquired?
The first thing, I've had people that looked at tax returns and they were like, oh, the tax returns didn't look good. You cannot just look at one type of document. You have to look at multiple and then correlate them together. But you don't have to do it yourself. You could bring in professionals to do it for you, right? Now, my most important thing that I'm going to look at is one of two things, EBITDA or SDE. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's the general metric used to define the valuation of a business, how profitable that they are. SDE, seller discretionary earnings, that is, if that business is a owner-operated business, then they tend to look at SDE. If it's a professionally managed business, then they're looking at EBITDA. The reason why they look at SDE on an owner-operated business is because owner-operators tend to do things like, I'm going to pay the nanny through the business and I'm going to call it employee childcare or something. And it's not technically an expense of the business. So you have to do an add back to show the true profitability of the business. All of that together is what's called SDE, seller discretionary earnings. For me, any acquisition I do has to pay me a minimum of $10,000 a month. Some of y'all may say, oh, that's it, 10,000. Listen, if I got 20 of them doing it, then I'm good. A minimum of $10,000 a month. That equals to 120 a year. For me, I also got to put a minimum of a 10,000 a month back into the business to help it grow. I want it to grow too. So that's another 120,000 a year. Imagine if the SDE of the business I was looking at is only 300,000. I've already eaten up 240 because I'm paying myself 10K a month and I'm putting 10K a month back into the business. That's only 60,000 left to service the debt that I'm incurring in order to acquire the business. So right then and there, that's why I do tell my students that a 300,000 SDE is the bare minimum, because if it's a 300,000 SDE, it's probably going to have a multiple. Don't worry, I'm going to fly through this part, but it's probably going to have a multiple of 2 to 3, maybe 4. So 4 times 300 is 1.2 million. That's going to be the potential valuation. If they're valued at 1.2, they're probably bringing in 1.5 or more. So just working through that, you tend to see, okay, the type of business I need to go after, which is typically going to have 300,000 in SDE, is probably going to cost about $1 million, 1.2, 1.3, 1.4. So I'm only going to go for businesses in that realm, right? Now, my metric is 500,000 instead of 300, but I tell my students that 3 is the bare minimum. I won't acquire anything that does not have at least 500,000 SDE because of exactly what I told you. I got to pay myself a certain amount. I got to put money back in the business, and I need to have enough to service the debt overall.
Got it. So you already have certain expectations that you set for yourself in terms of how much you want to make, how much you want to put back into the business, and then taking a deductive approach to that based on this 240,000 plus whatever debt would need to be serviced. These are the types of businesses that would be prime for an acquisition. That's an interesting approach, because when you start your own business, you don't have that luxury. You can control how much it makes, but it's like, you don't know that beginning. Like when you start a business, you don't know how much it's going to be making, but when you're acquiring, it's already established. It already has revenue and things like that. So you could be selective and look at these different acquisition targets as they align with the guidelines you set for yourself. That's really interesting.
So I mentioned before that what we're doing is not just buying or acquiring a business, we're acquiring cash flow. I grew up being told that cash is king. Then when I got older and realized it's not, I realized that credit is king. Then when I started acquisitions, I realized cash flow is king. It's one thing to have cash sitting down and you think you're good. It's another thing to have cash that's continuously coming in, right? So now I'm acquiring cash flow and I know exactly what I'm getting myself into right off the top of the acquisition.
Absolutely. Man, you just dropped a lot of game right there.
Fun, bro.
Yeah, it's definitely needed because, again, starting your business, I think sometimes people have an attachment to things they create, things they manifest. If you want to go into business, but don't know what you might want to do, this is definitely a viable route. There's different strategies, different methodologies to acquire businesses, even if you don't have the capital. I think you said there's hundreds of different strategies. So let's talk about BBI and the education and the things that you teach within your group. What are some of the benefits to someone who might be watching this interview right now and they're thinking about getting into the acquisition of businesses, maybe taking that route? What are some of the things that someone can learn through BBI, and kind of explain what is BBI first of all?
For sure. So BBI stands for Business Builders Institute. Although we're acquiring businesses, we still want to build them, right? So we got to know the core of all of that. I created BBI because I was having so much fun with these acquisitions and I started giving away acquisitions to people. People were like, I don't know what to do with it. So I just started teaching and I started recording some videos and say, okay, do this, do that. And then that became BBI. Now, BBI is not only about business acquisition, because you could be taught something very specific. Let's say you want to learn how to get into Airbnb and you might be good at it. You may know what to do and you still could be unsuccessful. Why? Because there's other things that you need to know too. You don't need to know about credit. You need your credit too in order to get more places in order to scale your Airbnb business. Oh, you don't know about business structures? Did you hear how Donald Trump buried his ex-wife on his golf course because he knew that there was a law that then makes it be classified as a cemetery, and then the cemetery cannot be seized, cannot have any type of taxes, no property tax, no estate tax, no nothing, right? So knowing the law and what to do, what business structures to get into and how to take advantage of tax laws, you got to know those things. We talk about generational wealth preservation through things like trusts and infinite banking insurance policies. We got to know all of these different things because it's not just one little thing that's going to help you to create that type of wealth. You need to know all of these and put them together. So the BBI became an alternative form of education. You could go to college or you could go to the BBI. We're trying to get it accredited right now. I got a student that's trying to acquire a college. We're in the middle of negotiations on that. And if that happens, I'm helping him. If he gets it, he's going to let the BBI be accredited through it. So we got plans, man. We got
wow.
It's amazing what we're talking about in the BBI. And it's not just the acquisitions, but that is the core of it.
So basically equipping students with all the different tool sets that you would need, from credit to law, business structures, all of these different tools to continue to grow, scale, and create your wealth. If anyone is interested, it's a wealth of information. I can tell you that firsthand. It'll probably take a couple months to really digest all of the information in the BBI. There's a link down in the description of the video. There's weekly calls where you actually go through some of the deals. It's more of a community where you pick each other's brains and support each other.
We invest together too.
Absolutely. I appreciate the time, man. You just dropped a whole bunch of knowledge. I hope for those watching, you were able to get some valuable nuggets out of that. Anyone interested in joining BBI, we've dropped a link in the description of the video. Definitely an investment in your education, as well as just proximity to other successful people in the field doing the same things. Great network, link in the description of the video. I appreciate this, man. I might have to have you back on. So we'll definitely try to get you back on at some point. But again, definitely appreciate having you. Any parting words for the subscribers, for the viewers before we wrap up?
Listen, there's three things that I've learned over time, three major things. I was always striving for financial freedom. Eventually, I realized that what I really wanted was time freedom, not financial freedom. You can be financially free. That means you can afford pretty much all of the main things that you want, but you're actively working on that revenue coming in. Then there's financial independence. Now you've replaced that active work for that revenue coming in with multiple passive streams. So now you're financially independent because you were still dependent on that one stream that made you financially free. But then there's another level called financially untouchable, right? That's big dogs. That's where we think we won't be that. But I promise you, if you learn how to acquire businesses, if you chose to, you can get to financially untouchable. It's a whole path that will take you to a millionaire if you choose to, and if you grind and make it happen, and it's nothing difficult at all.